Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
I'm going to start with a story because a few months ago, a friend who's also in real estate called me up and said, Shimon, what are you still doing in New York City? You should come to Miami. See, in Florida, they like business. And you know what? He's not alone. When you listen to the noise, you might think that New York City doesn't have an opportunity anymore. But when you look at the numbers, something very different emerges. We've had about $17.4 billion of investment sales transactions in the first 6 months of 2026. That's a 37% increase year over year. So capital is here, but it's selective. What you're going to see throughout this presentation in each one of these asset classes is that capital is investing in reset valuations, in fundamentals that are growing, in policy alignments, and when all of those don't exist, capital is looking for distress and basis. I'm going to start with the multifamily asset class, and there, not only we had growth, we also have three specific groups. We have free market multifamily, affordable housing, and rent-stabilized multifamily assets. They each behave differently. I'm going to start with a free market multifamily where most of the transactions take place. And there, investors are looking for yesterday's pricing with today's fundamentals. The values of free market buildings today, on average, are about 16% below what they were at peak, where rents have grown by 60%, almost 60%, in the past 6 years. That's a very compelling investment thesis for institutional investors. One of the transactions that took place earlier this year is the Columbus Square transaction. MetLife and UDR bought this deal in 2012, and MetLife sold their stake to Carmel Partners earlier this year for a 23% discount. It's the same asset, three different investors, three different decisions. Carmel Partner enters into a discounted deal. UDR stays for the upside potential and the accretive debt. Institutions weren't the only one investing. It was about deregulated buildings and value add and smaller tax class protected deals where private and international investors invested. So when it comes to free market multifamily, we have a deep bench of investors. It's all about the reset valuations and the growing fundamentals. Affordable housing is very different. There, it's all about the private-public alignment. And there are many different iterations and asset classes within affordable housing. One that is more aligned than others is project-based Section 8. There, the lower rents are complemented by rent subsidies, by property tax abatements, by the opportunity to lend from HUD and agency. And so the mission to provide quality housing for lower-income families is coupled with the ability of investors to get a return. Very few people know more about affordable housing than Robert Nelson, who manages and invests in thousands of units, and he's going to be one of our panelists soon. In the past 6 months, we've seen many project-based Section 8 transactions. Only 3 of them are here, 2 of which our company has sold for $120 million together. Project-based Section 8 also held its value compared to free market. Both of them got a reset valuation, but project-based Section 8 was closer to the free market world than to the rent-stabilized world, and that's meaningful because it encourages investors to reinvest in it and preserve affordability. Where did we see misalignment? You guessed right, in rent-stabilized multifamily. There we had rents that are low with no ability to increase them through subsidies or tax abatements. In fact, the one major item, Rent Guideline Board, provided us with 0% growth of rent just a few weeks ago. What does that do? In the past 6 years, expenses have grown 2.5 times more than rents. The net operating income's eroded. It means financial and valuation distress. It also means physical distress. It also means when you get a vacancy as a rent-stabilized owner, you got to think whether you want to occupy the unit or not. And as a result, 57,000 rent-stabilized units are vacant today. It's about 6% of the total million units that we have in that category. That's a lot. What does it do to valuations? The past 6 months, these are the buildings that traded. If you look at when they traded before, the average discount is 63%. One of these deals was the Pinnacle bankruptcy that sold for $451 million, or 60% below its 2018 valuation. Long-term families sometimes decide to exit that rent-stabilized market as well. So a lot of challenges there, and the city and state have two main tools to implement in order to fix it. One is to convert rent-stabilized into affordable housing, does require budget, and two is to encourage private investors to reinvest in rent-stabilized housing, perhaps one-time market reset for the 57,000 units that are vacant now. That will be helpful. Maintaining the status quo will just accelerate financial and physical distress. So rent-stabilized housing is all about misalignment. It's a structural issue that we need to solve as a city. Let's go to a happier place than rent-stabilized. Office. Office has done extremely well in the past 6 months in three main categories. Class A office, Class B that's being repositioned, and office to residential conversions. I'm going to start with Class A, and there it's all about the fundamentals. Some companies are way above the average of $90 a foot, in the 300s a foot range. 23 million square feet were leased to Class A office building in the past 6 months alone. And these are high-end law firms and financial institutions and tech companies, some of them renewing their own leases. And when you ask why, you gotta ask the tenants. You gotta ask the employees. One senior partner in a major law firm told me this: I get into Subway and go right into my Hudson Yards building to go to the gym, then go to my office to have lunch with one of my clients. And that's all within the same campus. So what ends up happening, the experience is just not an office, it's also hospitality. That retains and attracts the best talent. That's why these companies are interested in living there and paying the prices. Investments follow suit. SL Green, a conviction buyer of office, bought the Park Avenue Tower from Blackstone. They bought it at the value Blackstone bought it 10 years ago, approximately, but with conviction that they can reposition and enjoy the high fundamentals. So here again, what we have is the same asset, two different investors, sophisticated investors, and two different decisions. In the past 5 years, we've seen some construction in Class A, and the latest one is Extel developing on Park Avenue as well. So Class A is doing well, and it trickles down to Class B. Fundamentals there grow, and we've seen that on the rents, and we've seen some interesting repositionings of Class B to B plus and A, and prices per foot in that category have increased. So that's different than what we've seen last year. The last category of office is office to residential conversions. It leads me to speak specifically about development. Development is about policy alignment, and office to residential tells that story. 101 Greenwich is one of 17 transactions that traded, but also one of 65 transactions that traded from office to resi in the past 2 years. In fact, we have about 16,000 units in the pipeline to be converted right now over the past 2 years. Why is that? Good policy. 467M is the tax abatement that allows developers to make economic sense of these conversions and allows the city to receive 25% of these units as affordable. Good alignment. Good alignment existed also in the prior tax abatement called 421A. We've seen Atlas buying on Pearl Street, the old 421A that was vested in that case, developing 600 units. Do we still have alignment in ground-up development when it comes to tax abatements? We do. With the 485X, we've seen 112 different lots trade, most of them very similar to the Carl Street that our company sold earlier this year. Most of them are going to be 99 units and under. Why? Because when you develop above, the 485X doesn't work economically. So we see that, and we ask, what about affordable? It's a lot more complicated. Affordable housing development, ground-up development, is something that requires a lot of work with the city and state. We're very fortunate to have Brian Kelly, the president of Gotham Development, to speak specifically about the complexities and opportunities in that world as well. The city needs to produce about 60,000 units per year in order to catch up to the lack of supply we have here. We're producing maybe half of it. When you take into account what we're losing on rent-stabilized units, it's maybe a third. So we need to think about policies that encourage more development in the city to create the supply we need to overall lower free market prices through supply. Retail, there we've seen two main items. The first one, brands are buying their own permanent homes. We've seen Van Cleef buying their own lease on Madison Avenue. They joined Prada and Gucci from a few years ago. We also see retail service companies taking space. Those that cannot, things that we cannot do or buy on Amazon are right there. The capital markets, we've seen a lot of consolidation in that world. The bigger banks are becoming bigger, and lenders are lending, but more selectively. It's all about the client, the business plan, and the asset. Ralph Bambaka, who leads TD, is going to tell us more about that when we get to the panel discussion in a minute. All right, what should we look for? Clearly, interest rates are every investor's mind. The economy and the stock market are going to affect fundamentals if there's a change. So we got to watch for that. Mortgage maturities, not just in the sense of distress, but more in the sense of more transactions. Mortgages are coming in at much higher rates to refinance. And lastly, policy, the city policy, specifically when it comes to preservation of affordable housing and rent-stabilized housing. How is the city going to react to that? So going back to my Miami friend and the question, we can listen to the noise, but when we look at the capital, there are investments, they're selective, they're about fundamentals and policy alignment, but even if they're not, they don't exist, there's a lot of distressed investments in rent-stabilized multifamily. So I choose to follow the capital than follow the noise. Thank you.